The opinions expressed on this program represent the viewpoints of individual authors or contributors and do not necessarily reflect those of Troy University.
Hello and welcome to Econversations. I'm your host, Dr. Dan Sutter of the Johnson Center for Political Economy at Troy University. Has progress in the United States only benefited the top 1%? Can government policies reduce inequality if we choose to do so? Answering these questions requires being able to measure the distribution of income in the United States and the extent to which this unequal distribution has changed over time. How do economists measure income inequality? And how do tax policies interact with this measurement of inequality in the market to make measuring the distribution of income challenging? Joining me on Econversations today to talk about these issues is, in his research contributing to this analysis, is Dr. Steve Miller, the Abs-Bibby Professor of Economics at the Johnson Center here at Troy University. Welcome back to the show, Steve.
Thank you, Dan.
So let's start by saying, lots of people are concerned about the distribution of income in the United States. The Occupy Wall Street movement popularized this phrase of the top 1%, and like how the top 1% is benefiting at the expense of the rest of us. And so that's been an important, theme in public discourse over the last decade or so. If we want to evaluate questions like this, or whether the amount of the inequality that we might observe in the society is unfair or inconsistent with the market, we need to be able to measure inequality first, right?
Right. And so to do that, we go to measures of income distribution. And there are different ways of doing that. But the basic idea in terms of income is to look at how much total income is received by people in the United States, for example, and then look across that distribution how much of the total income is going to the top 10% of the distribution or the top 1%, or sometimes even the bottom 10%.
Mm-hmm. And without this information on what has happened to the income distribution, we don't even know if claims like this would actually be true or not, right?
That's correct.
And so it's vitally important, even before you get into kind of making any kind of judgments about whether it's rising inequality is a problem or not. We need to know what the facts are, right?
Absolutely. And so that's where a number of economists have come in over the last couple of decades in trying to measure inequality better.
And in particular, a couple of economists who've made a really important contribution, and we're going to want to talk about a contribution they made to measuring inequality, and then some policy implications or that they've drawn from that. But to first talk about this whole question of measuring inequality, there are a couple of economists who made a very big contribution to this effort, right?
Yes. So, and they both happen to have French names, Thomas Piketty and Emmanuel Saez. And they together kind of came up with what's viewed now as the gold standard for measuring income inequality in the U.S. historically. They have worked on other countries, but the data have been most available and richest for the U.S., and that's what they focused on. They have also talked about wealth inequality, which is more about what people have rather than what they're earning that can be measured in terms of their tax returns or census data.
And that's, I think, a good point. Let's elaborate on that a little bit, because we often measure income, but probably when we're talking about the haves versus the have-nots, we actually probably mean wealth. So what's this distinction between income and wealth, and what's the differences in terms of measuring it?
Yeah, well, one reason it matters for debates about inequality and thinking about haves and have-nots is that there are people who may have very high incomes who have relatively little wealth because they spend it all or they're paying off past debts. And there may be people who have fairly low incomes but fairly high wealth, right? And that's kind of the millionaire next door story. People who over time, just steadily through saving and investing, were able to accumulate wealth. So wealth is about what you've accumulated. When we think of wealth, we do think about a big fancy house with a swimming pool. But the best way we have to measure wealth is really what's in people's bank accounts. And the best way we have to measure income is what they report.
Okay, so measuring income is important, and then we'll get into some of the details, but the Piketty and Size made an important contribution here in terms of putting together a data set, and sharing that data with other economists so that we can then do research or look at what they found and play around with it, right?
Yes, and unlike kind of any previous attempt to look at inequality over time, this spans 100 years now. So initially it spanned almost 100 years, but now it spans 100 years. So the data set starts in 1913, and they have data through 2013. So it's 100 years of income inequality in the United States.
And with this data set that they've put together, now made available, other researchers like yourself have been able to go ahead and analyze this data further, which is really important, because we'll get into some of the policy implications they're trying to draw from their findings or their take on their findings. But by sharing the data, they really help allow us as economists to move this conversation forward. And that's a really important thing, right?
Absolutely. For any empirical research, any data-based research, whether it's in economics or finance or accounting or government, it's really important to have the data available to other researchers so that they can try and replicate your findings and see what else they can learn from the same data set. And Piketty and Saez have been very, very good about that. They have always made all of their data publicly available since early on in their project.
Okay, so let's get into some of the details here. We want to touch on what's important in the details, but we don't want to get into too much of the details, because we're going to very quickly, one of the themes here we're going to get into is how tax reform has complicated this whole issue of measuring inequality. But when we talk about measuring inequality, historically economists have used two different approaches to try to get our data from, right?
Right. So the two most popular sources of data in the U.S. are from the Census Bureau, which is from Census Bureau surveys when they do the U.S. Census, and the Internal Revenue Service from people's tax returns. In some sense, these are both sources of data that people report themselves, and there are reasons to look at them differently. I will say the overall trend in terms of looking at income inequality in particular, it's very similar. In other words, the shape of the trend over the last 100 years looks the same whether you look at Census Bureau data or IRS data. The IRS data, though, is viewed more and more nowadays as being higher quality. And I think part of that is because that's what Piketty and Saez were able to, they were able to get much more detail in those data.
And just in terms of the reliability of the data, I mean, one of the problems people raise with survey research very generally is that when you're doing a survey, what's the incentive of a person to report accurately, or even aside the accuracy part of it, is just to think carefully about what's my actual answer to this question, as opposed to just make up some answer, right? So by contrast, the income tax data would seem to be far more reliable, wouldn't it?
I would say so, but I would say so especially for recent decades. So early on, in terms of the income tax, it turns out the economic historian Phil Magnus over at Berry College has looked into this some. It does turn out that there may have been a lot more misreporting to the IRS on people's income in the early part of the 20th century. But the IRS has gotten stronger and more vigilant over the years, and it's very costly, very risky to misreport your income to the IRS. So that alone would make it seem, at least on the surface, to be a better, more reliable source of data.
And when people do their taxes, or if they're wealthy enough to have their accountants do their taxes for them, they have all their records in front of them. And so it's not just a matter of trying to remember what you think you might have earned last year when you're doing a survey. You actually have the data there, and there, you're either going to owe more taxes if you don't do it right, or you could be prosecuted if you fill out things incorrectly. So I mean, it would seem like the tax return data should be more reliable.
Oh yes, that's a good point too, right? If I were to ask someone to remember what their income was over the past year, that's a little different than taking the number that they reported when they actually added up all of their income from various sources on their tax return.
Okay, there's another, when people look at the income distribution in the United States, there's another element of this as well, where they're looking at what is called pre-tax data, pre-tax income or post-tax income, and then also whether you're adjusting for government transfers or not. So tell us a little bit about this adjustment.
So as the data set sits, as the Piketty as data set is presented, it is unadjusted. Mm-hmm. So there is no adjustment for after taxes. It's all pre-tax. In other words, it's the number at the top of someone's tax return in terms of their total income. It's not what they've made after taxes, and it's not what they've made after maybe they've been able to receive some government benefits that are untaxed. So it really is only taxable income that you report to the IRS. There are ways to adjust and make adjustments for that. When researchers have done that to try and kind of make the Piketty as data series a little richer, what they've found is it doesn't make a huge difference in terms of the overall trends, but it does change what inequality looks like. It changes the level of inequality a little bit to make those adjustments for after tax and after transfer.
And so one way of putting it is if you're looking at like the bottom 20% of income earners, then when you factor in the amount of transfers they receive from the government, their situation is not as dire or desperate as necessarily as it might look like if you just look at their income, right?
Right. Well, and keep in mind, even though it's a long data series over many years, it's not tracking people, it's tracking a snapshot of the income distribution. It's not tracking people over time, it's tracking the distribution over time.
Right.
And what I mean by that is there may be someone in the data series who now looks to be in a very low income quantile, very low percentile, fairly low level of income, but they've actually earned a lot of money over the course of their lives. They may have been very high income over the course of their lives, but now they're retired and they're drawing on that, and their taxable income turns out to be fairly low. And so people's income levels changes over time. It turns out that over 10% of people in the U.S. at one point or another find themselves in the top 1% of the income distribution.
Yeah, I think that's an important point, and it's one that's often missed in these categories. We can show a graph over time of the top 1% of earners, and I think we'll have a graph showing the top 1% or top 10% of earners, but it's not, even with this tax return data, it's not the same persons each year. It's whoever happens to be the top 1% of people with the top 1% of reported taxable incomes in that particular year.
That's exactly right.
And some people have a period of time in life where they make very high incomes, but that doesn't mean they're in the top 1% every year.
That's right.
I mean, I guess probably professional football players or other professional athletes would be a good example. You might make millions of dollars, but for a short period of time. I mean, alternatively, people who run a business and then they go to sell their business, or their business is successful enough that it goes public. They make a whole bunch of money in 1 year, but that it looks like they have this huge income, but it's not like they're earning that every single year, right? Exactly.
Or even the sale of a house. You can realize income from the sale of a home, and that can push you up into a higher percentile.
Okay, so this is just a little bit of background here to get us into the, I guess, the policy implication that particularly Thomas Piketty has drawn from his analysis of this data. And this is referred to as, I guess, the great Uturn in American inequality. So here's a graph that is drawn from his work. Tell us what this is.
So what this says is that in the early part of the 20th century, income inequality was very high. In other words, the top 1%, you earned a very large share of total income, over 40% during the early part of the 20th century. And then in the middle of the 20th century, just during really World War II and then after World War II, income inequality was reduced. We lived in kind of a golden age of equality in the U.S., and then starting in the 80s, it started to rise again, and now it's back up near historic highs.
So this is also related to policy changes, because this is looking at pre-tax income. So in some sense, it's a measure of the amount of inequality out there in the economy before the government starts to try to do anything to make this more equal. And there were some tax changes in here that Piketty particularly draws to claim that we need to change our tax policy. So how does tax policy enter into this story or this U-turn?
Okay, so I'm going to leave the early part of the 20th century aside. There are economic historians and others who are doing research on that, including Phil Magnus and Vincent Galoso. But what's interesting is in that golden age of income equality, right? So during the 50s, 60s, and 70s, especially during the 50s and 60s, what you see there is, in terms of tax policy, that's when top rates, in other words, for people who earn the highest income, they were paying really, really high marginal tax rates. So in other words, if they earned an extra $1, they might be paying 80 or 90 cents of that in taxes. And so that's an era of very, very high tax rates. And what happened in the 1980s, particularly in 1986 with the Tax Reform Act of 1986, is that tax rates were, the number of rates were reduced, but then they were also all lowered and simplified.
And so Piketty argues that this lowering of the top tax rates has helped fuel this rising income inequality in the United States, right?
Yes, and he would say that what happened was when those tax rates were lower, people in the top 1% chose to receive more personal income. And so because they chose to receive more personal income, that shifted the equality numbers.
So in that sense, worsening income inequality, I guess you could debate whether or not it's a highly problematic, but it could at least be addressed, at least according to this graph. It looks like it could be addressed because when we had very high tax rates, we had a lot less reported inequality, right?
That's correct.
Okay, so then this is the interpretation here as opposed to the data. It has been quite controversial, hasn't it?
Yes, it is. And I should give credit to Alan Reynolds at the Cato Institute and Scott Winship at the Manhattan Institute, because both of them pretty early in terms of Piketty and Saez's studies were very focused on the Tax Reform Act of 1986 and how it didn't seem plausible to them that there was such a big change in actual underlying equality, right? In just 1 or 2 years after 1986.
Yes, because I think if you really want to zoom in there, you can see there's like 1 year there where there's this huge jump in inequality from 1 year to the next, and a pretty pronounced rise over the course of just about 8 years.
Yes.
Or 6 or 8 years. And that 1 year jump seems particularly fishy because if you were to think about it, maybe there are forces in the U.S. economy that are leading to a less equal distribution of income, but they're not the kinds of things that cause like a light switch to be thrown or anything. They would be acting more slowly, wouldn't they?
Yes. I mean, if we're thinking about how much of total income is being received by people at the top, that is something that you'd expect to happen gradually if there was some underlying social or political reason. If it's all happening in 1 or 2 years, or even if it's all happening within 8 years, but most of it within the first year or two, that makes you wonder if it isn't just a change in the way something's measured, right? Whenever you see a rapid change in data like that, the first thing that should come to mind is what's been changing in the way it's measured, because that's what you look for.
And so it's both a change in the way it's measured, but then there's also an interaction with the tax code, because we are looking, after all, here at taxable income or income reported to the IRS for taxation purposes.
Yes.
And in the 1980s was when I was first studying economics, and in advance of the Reagan tax cuts in 1986. I mean, one of the big arguments that economists were making at that time there was that these income tax rates are so high is leading people to do a lot of stuff in terms of sheltering their income instead of investing it in productive businesses. And if we lower tax rates, then people will invest more productively. And yes, they'll be able to keep more of their income, but they'll also be they'll be helping grow the economy. And so if that was to be true, and people were to stop sheltering their income and using it more productively or hiding it and so forth, so you could see you would expect to see a change in reported incomes. And so you've got a problem here in that how you're trying to measure income is tightly tied to tax policy itself, isn't it?
Yes, it is. And that's the thing is what has actually been measured hasn't changed, right? It's still personal income. But the issue is when the policy changes, what's reported as personal income can change. There's other ways to earn income there's other compensation that people can receive that may or may not count as personal income on their tax returns. And that's what changed in the wake of the Tax Reform Act of 1986. And you mentioned an important piece of it, is there was actually a lot of policy changes that made it harder to hide income from the IRS. It actually made it so that more income had to be reported as taxable income. So one reason taxable income, personal income, increased for the top 1% is they no longer had so many shelters for it. There were no longer so many loopholes for people to use to not count part of their income. And so that, of course, led the top 1% to be reporting more income. And by the way, it led to the top 1% paying a larger portion of the total tax burden. So that's all going on at the same time. Now, the very interesting thing for me with the Tax Reform Act of 1986 is it also did something pretty unique in terms of our tax history. For the first time ever, the rate that these top 1%ers were paying on corporate income was now higher than the top rate they would pay on their personal income. Okay. And so they were able to take what used to be reported as corporate income and therefore wasn't counted in this series, and then report it as personal income. And that led to a very, very dramatic jump in how much personal income was being reported by the top 1%.
Okay, let's get into this in a little more detail. I mean, again, I'm not a tax accountant, and I don't want to bore people with anything too detailed in terms of things that only accountants should talk about, because anybody else would fall asleep. But there is an important difference here between two different types of corporations. And it's really important because it really interacts with these tax rates, and it could be explaining what's going on here, right?
Absolutely. So if you own a corporation and you use and you treat it as what's called a C corp, right? And you report the corporation's income through a C corp, it will be taxed at the corporate income tax rate. If you do it as an S corp, this is sometimes called pass-through income from a business you own. If you report it as an S corp, then it is subject to your personal income tax rate, and you report it on your personal income tax form.
Okay, and so other people are aware of this, and so then the question becomes, well, what are you going to do to try to account for this, right? And so, what are some options for addressing this?
Well, some researchers in the past, what they've tried to do is they've tried to then adjust the path of income inequality going forward. They tried to adjust the increase in the share of the top 1% going forward, realizing that there was this level change that was really due to a change in tax policy.
No, I think we should get to this slide here.
Yeah, so and what I and my co-authors did is we said that's not really right, because what's happening when the tax code changes like that, when you have income that wasn't being reported as personal income and is now reported as personal income, it's an income that had always been there, has now been revealed.
Right.
And so it's not that income inequality is overstated from 1987 onwards or 1986 onwards. It's that income inequality before, right, the income share of the top 1% was underreported in the previous years because there had been corporate income that people were receiving that wasn't being reported as personal income. It was just being reported as corporate income. So what we did is we made an adjustment based on the difference between the top corporate income tax rate and the top personal income tax rate. That borders on being too technical, but that's what we did. We made an adjustment based on the difference between the two rates, and then we calculated back before 1986, going back to 1955, or actually we were only able to go back to about 1958, I think. And when we did that, what we found is, yes, that changes the overall pattern. It makes that flat part of the U-turn, it makes that flat part less flat, right? It makes it seem more like income inequality has changed less over time.
So then essentially what you're saying is, like, in the 1960s and 1970s, people were making more income, or some of the wealthy people had more income than they were reporting as personal income.
Right.
And you're just trying to get back and go back and adjust for that. Alternatively, some people have tried to project forward and said, like, well, what if you adjusted Piketty and Sice's data going forward for this tax change? So you're trying to do a different type of adjustment here.
Right, and I believe it matters. I believe it's really true. It's not that income inequality is overstated since 1986. It's that income inequality was understated through the 50s, 60s, and 70s.
And that would be really important as well, because another part of this is in the 1950s and 60s, our economy actually grew at a very high rate, which at one level would seem kind of inconsistent with one element of tax theory, because in the 1980s, the thought was we need to, supply side arguments were along the lines of, well, we need to lower the top income tax rates to encourage people to generate more income, and then our economy will grow faster. Well, back in the 1950s and 60s, we had, like, up until the Kennedy tax cuts, we had 90% or 91% was our top income tax rate, but we still had very robust growth at that point in time.
Yes.
But I guess what you're saying is that it's a little bit of, those high tax rates might have been a little bit of a illusion.
They were a little bit of an illusion because there weren't many earners paying those super high rates. They had ways to avoid them. One would be to take more income as corporate income and then find other ways to increase your standard of living and lifestyle through company money, right? And the other thing going on is there were still all kinds of shelters and exemptions back then. The tax code arguably had more loopholes in the 50s and 60s than it did after the Tax Reform Act of '86.
And there were certainly a lot of corporate perks.
Yes.
They're back in the 1960s and 70s, and it sort of makes sense. If you were going to pay executives salary, they'd have to pay they might be paying a 70% tax rate. It's certainly a lot cheaper for their company to pay for their golf club membership instead of giving them the cash for them to pay their golf club membership, although there's an economic cost of using all these in-kind benefits, right?
That's correct. There's an economic cost, and so right, there is no such thing as a free lunch. But if you think in those terms, it's people were still able to enjoy a fairly high standard of living. There may be some losses along the way, some inefficiencies, but their standard of living isn't exactly the same as their reported personal income.
So this ends up being important in terms of thinking going forward, because if there was more inequality than there appears to be in the Piketty data, or Piketty size data looking back, then simply raising the top tax rates isn't necessarily going to restore this golden era of equality, because the golden era wasn't so golden.
It wasn't so golden, and an important thing to understand about the golden era of equality, which I guess we should throw quotes around, is that was when people at relatively low incomes were paying more of total taxes. See, one thing that happened after Tax Reform Act of '86, like I said, is it was harder to avoid those taxes, and so the top 1% was actually paying a much larger share of total income taxes than everyone else. And that's an important piece of this, is that every time there's been a reduction in tax rates and an increase in exemptions and all of that, what's happened is that the poor actually end up paying less in taxes, and the top 1% actually end up paying a lot more in taxes.
So despite lower tax rates, they're actually paying more of the total tax burden.
Yes.
And I think that's a really amazing point to remember. So any last things you want to wrap up here?
Well, this reasoning and this study is very applicable to the tax reforms that just happened, effective this year. What happened there is that the tax rates were lowered, but the tax base was broadened. In other words, it's harder to kind of avoid the taxes, but many people are going to drop off and pay less in income tax because the standard deduction is so high. And what we're going to see is we will probably see a reduction in the inequality numbers as Piketty has measured them.
Cool. Very, very interesting. Well, thanks for coming on. And thanks for joining us. Join us again next time for another Econversations.